Right, hello. So welcome to the Stock and Profit Trading Mastery course, version 2.0. I'm really looking forward to all that we're going to be learning in this program. I can tell you for certain that this is going to give you clarity, this is going to give you precision, and it's going to help you really build the foundation you need to succeed in the market long term, not just short term. I'm going to be sharing the exact strategy that I trade with in the market every single day, and this is really going to be right. It's going to really be interesting. So to begin with, we're going to be starting with chapter 1, and here we're going to be looking at the basics of liquidity and inducement. Now, in the basics course, I had already laid the foundation for some of when you talk about market structure, what is market structure, how to identify the trend, how the market is trending, where the market is trending, where the market is coming from, where the market is going to. So we've looked at that in the basics course. So I want to believe you already have an understanding of market structure. And now we're going to be building much more deeper, and we're going to be looking into liquidity concepts and inducement and all of this, confluences and little things that eventually make you become a pro trader. So now, starting with the basics of liquidity concepts. Now, these are the building blocks, okay, that I love to share with everyone when I begin to talk about models of entry when it comes to trading and all. Now, firstly, you have to understand market structure, and we've looked at that in the basics course. I believe you've already gone through that. And you understand what market structure is, so it's nothing foreign to you. Now, market structure is the basics. If you understand market structure, it is easy to now build on top of that, every other thing. The second thing is supply and demand. You need to understand what supply and demand means. We also looked at that in the basics course. And then after that, we begin to talk about liquidity. Now, what is liquidity? Now, this is where you begin to deepen your understanding of the market, of price action in the market. And then from there, we begin to talk about liquidity inducement, and then after that we begin to talk about entries, exit. How do you enter the market? How do you exit the market? What are the models? What are the risk management, the trade management models one can use to perfect the entries and the exits in the market? And then lastly, the level of mastery is where you begin to talk about psychology. At this level, this is where you've gone beyond, you understand the concept, you understand the strategy, you have a grasp of it, but here you're talking about psychology. This is where you're talking about the level of mastery, okay? You really are becoming a master of yourself, a master of the market. So these are the building blocks for anyone who really wants to succeed in trading. Now, market liquidity, the standard definitions. Now, generally speaking, liquidity is the extent to which an asset can be bought or sold quickly and at stable prices and converted to cash. Okay. Now, in effect, liquidity refers to the amount of supply, sellers, and demand, buyers in the market, and if these transactions can take place easily. Okay. How liquid is the market? You probably have heard that before, or even when it comes to one-on-one interaction, someone can say, "Oh, how liquid are you? Okay, do you have cash?" That's what they mean. Okay, now, so we'll talk about the definition of illiquid. An illiquid market will have chaotic moves or gaps because the level of buying or selling volume at any one moment can vary greatly. The lack of liquidity is often associated with increased risk. Now, a liquid market, on the other hand, is also known as a deep market or a smooth market, and price action is also smooth. So a liquid market is generally associated with less risk, as there is usually always someone willing to take the other side of a given position. Okay. Now, these are just general definitions. Now, we'll talk about market liquidity. Okay. Now, in Forex, liquidity matters because it tends to reduce the risk of slippage, giving fast execution of orders and tighter bid-offer spreads. Okay. When the market is very liquid, it's easy, for you to have your trades filled at the correct price. Okay. You don't have slippage, you don't have all the jumps and all the necessary gaps and all of that. Okay. We're going to be looking much more in depth into all of this. Now, we use technical analysis to read the market, while supply and demand informs us of where large orders may be seated. Okay. Now, basically, liquidity serves as a magnet that attracts price to itself. And as we look at the entry models, eventually, I think in chapter 3, we're going to be looking at the exact entry models. you'll begin to understand, how liquidity sort of attracts price. Because when we talk about entries and exits, you usually want to exit where liquidity is lying, so we're going to be looking at all of that. But it's very important to understand this foundation, because this will help you in the long term. Now, still on market liquidity. Now, liquidity can be seen everywhere in the market, literally. Okay, now I have a few examples here of liquidity concepts in trading. We've already looked at structure, so the shapes we have here on the screen shouldn't be foreign to you. So starting with this one here, you can see we have this swing liquidity. So at every point where you have a kind of inflection or where you have structure, you basically have liquidity there. So for a bullish trading market, for example, where you get this low and then the market continues in the bullish direction, that simply means a lot of money came in here. So there's liquidity lying around there, simply put. And the same thing also for a bearish market. Now, how about double tops and bottoms? The same thing also, where you have those structural inflections, essentially telling you that there's a lot of money that came into the market to create that structure. That is simply what it means. The same thing also does apply to bullish and bearish trending market, where you have all the lows and the highs for the lows, for example, for a bullish trending market. So that creates for you the liquidity pools where you have liquidity. And the same thing also for the bearish trending market, where you have all of the the tops and the highs is essentially that drives price down. That tells you that a lot of liquidity lies around those areas. So we're going to be piecing all of this together so that you have a good grasp of what this means in the market. Now, inducement. What is inducement? Inducement also is a concept that's very important to understand. Now, just a second. Just a sec here. Okay, so inducement is also a concept that is very important to understand, right? Because with inducement, you're simply looking forward to say, price may essentially clear out this particular area before the move happens. Okay, so this, for example, we have here this double top, and as you can see here, price sort of clears that, taps into a supply zone before it drops, essentially making that area an inducement to the supply zone. Okay, and the same thing also for this one. For example, you can see how this also played out. Price clears this high, taps into the supply zone and drops. Essentially, the area where price clears, okay, the area before a supply zone or ahead before a demand zone, could serve as liquidity in the market at any point in time. So liquidity, sorry, I said could serve as liquidity, it could serve as an inducement area rather, at any point in time. So when you look at liquidity and inducement, in a lot of ways, it's still the same thing, because the inducement, there's also a lot of money lying around there, and price may just decide to take out the entirety of the inducement or the liquidity lying around that inducement area before the major move happens. Okay, and we're also going to see that practically in the market. Now, early entry without accounting for the inducement setup, this will typically induce buyers to buy to the supply zone or sell too early from the supply zone. And we're going to see how all of that plays out in the market. Now, here is a typical example for you. So you can see here we have the structure. So first high, low, creating for us here an inducement area. Of course, there's liquidity around here. Price returns, clears out that inducement, that liquidity, taps into the demand zone below that area, and then continues to move upwards. Okay, so that is essentially it. So you have here the market creating an inducement area, price returns, sweeps the inducement, taps into the demand zone, and moves up. Simple. Okay, very, very simple concept. You don't have to complicate things. Okay, and we're going to see that practically as we go through the models, but I want to believe this is very simple for you to sort of understand. Okay, now liquidity sweeps and sweep zones. On the other hand, we have what we call liquidity sweep. When you have, like I mentioned earlier, when you have when you have structure at every point in time in a bearish trend market, if you have the highs that lead to the break of structure, in the bearish direction, creates for us a liquidity zone, a liquidity area. So what I mean by that is this: look at this candle here where I have my cursor, right? Now you can see here that price registered a high here, created a low, price returned, swept that high, and then created a new low here. Okay, this swing low here. Now when you look at that, this price returning all the way here, clearing this high, is referred to as a sweep, liquidity sweep. In other words, price swept the liquidity at the stop. Okay, what that now eventually creates for us is that this sweep of liquidity creates for us what we now call a sweep zone. Okay, so this is not just a supply zone, but we'll call it a sweep zone. It's a supply zone, but now because it cleared the previous high, it's now referred to as a sweep zone. I hope that is really clear. So this is a sweep, liquidity sweep, leading to the creation of a sweep zone. Now price, of course, created this low, came back, created this highs, created another new low, created an inducement area, price returned, cleared the inducement, tapped into the sweep zone, now the supply zone, which also doubles as a sweep zone because it cleared the previous high here. Price tapped into that, and then price sells off. Okay, so I hope this is really just beginning to come together. If of course this is completely new to you, it's perfectly okay. You understand this as we look at the concept even much more deeply. So these are the foundation, or this is the foundation for what we're going to be looking at in the course. Now we're going to be piecing everything together, market structure, liquidity, and inducement. I'm just going to show you a few chart examples and walkthroughs that I believe are going to be helpful to you. All right. So that said, let's do this. All right, so let's go through the chart. Okay, so we're going to be going through a few examples of piecing everything together, essentially. Okay, so market structure, liquidity, and inducement. So here I have Bitcoin. As you can see, this is a very recent price action on Bitcoin here. Today it's at time of recording that this is the 9th of February. So you can see here we have Bitcoin doing its thing. So Bitcoin had registered a high of about 109,000. Okay, and we can see the market obviously is bearish because we can see multiple breaker structure. Let me just take this out so we can just what we have here. So let's draw this. I believe you're already familiar with structure, so I don't have to really spend time explaining what's happening here. But let's just draw this. So obviously you can see here that we have low, high, low, high, low, high. So obviously the market is bearish, isn't it? Now, based on structure, if the market is going to continue in the bear direction, essentially we're expecting price to come here. Okay, now that's essentially what we're expecting price to do, right? So we're expecting price essentially to head towards this area. So if we're to draw this in terms of structure, we're going to say low, high, low, high, low, high, and price is heading back this direction. So all we need to do in this instance in the market now, we're definitely not going to be looking for buys. Okay, so the first thing, let me not rush this. We're looking at three things: structure, liquidity, inducement. And that's essentially what we're building our trade ideas around. So structure first, we've identified the structure. The market is bearish. Simple, right? Super simple. So for you as a professional trader, you're not going to come into the market and you begin to look for buys on Bitcoin based on what the market is giving us right now. It would make no sense. So you're only interested in sales until the structure or the order flow in the market changes from bearish to bullish. Then you can begin to look for bullish, opportunities. So first, we've identified structure. So let me take this out. Now, with that in mind so all we now need to do is to now look for other things, that essentially make up the concept we're going to be looking at. And of course, just to mention that we're going to be looking at in chapter 3, we're going to be looking at the exact trading models, 4 of them, that we have to look out, you need to look out for in the market to trade the stock in profit strategy. Now, so we're going to look at a few things here. Let's zoom into this area. So this was a trade that played out just on Friday, on the 3rd, based on the time of recording this video. So let's identify a few things. So first, let me see, let me use this tool. So first, we have here, the first thing was that, let me see if you get that. Did you get that? Liquidity sweep. Awesome. If you got that, clap for yourself. Liquidity sweep. Awesome. What's the second thing we're looking for too? Did you get that? I hope you did. Inducement. Perfect. Then what else are we looking for too? So we're looking at structure first. We've identified liquidity sweep, we've seen inducement, we've seen. Then what else are we looking for to? We're looking for to price the entry, okay? Price mitigating, our supply zone, which also doubles as our sweep zone. And why is it a sweep zone? Because it swept the previous high. Simple as that. Okay, so we have this, and then with that we have all that we need. So you can see here that first, price high, okay, price swept that high, created a low, returned all the way here, took out the previous low, creating for us inducement, an inducement area, and now price return, swept the inducement, tapped into the supply zone, which is also of course a sweep zone because price swept this guy, the high of the previous candle there, and then price tapped into that, and then price sold off. A standard entry for a standard entry based on the stock and profit models that we're going to be looking at. Okay, so this is it. We've seen structure, we've seen liquidity sweep, we've seen inducement, and what else? Inducement, liquidity sweep, structure. Simple, just putting it together. Okay, and then the trade idea materializes, and that is as simple as it gets. Now if we just go back in time, also we can see more, I believe. So you can see here for this area here, you can see what we have here. We had low cleared, price high, low cleared, creating for us an inducement area. Price returns, taps into this supply zone, and then sells off. Okay, so what do you observe here? The difference between this and the other trade we just looked at, this area here, or this supply zone, is not a sweep zone because it did not clear any specific structural high there. Okay, so and that is it. Price taps into it, but the inducement is constant. Now one thing you have to take note of is the inducement is almost always constant in all of the models we're going to be looking at. Price will always have to sweep inducement, the inducement area or the inducement zone, before we get that sell that we're looking for. Okay, so this is it. So let's take another pair. This is New Zealand USD. Okay, so New Zealand USD, let's look at what we have here even going on. So you can see here that we have, let me just use this tool to draw this. So first, always identify structure high. Can you see that? You can see that. This is also, you can refer to, well, it's swap, the market. This is basically just a market swap. So low, but price created this high here. You can see that low. And then what happens? Price returns all the way, sweeps the inducement zone, taps into the supply zone, as you can see here, and then what happens? Price is dropping. Okay, as simple as ABC. Well, in theory. Okay, so all we need to do when we begin to look at the models is how do you ensure that you identify all of these things before you take a trade. Okay, so let's take another pair. Let's say USD card. Do we have something we can look at here? Yes, let's look at this. So look at this here. Just a second. Okay, so we can see this. So let's also draw the structure first. So you always want to make sure you identify structure. So here, high, low, another high. Then price returns, clears this inducement, because you can see this structure here creates an inducement for us. Price clears that, taps into the demand zone, and then boom, price, leaves, right? So you can see that it happens over and over and over and over again. Okay, so market structure first, liquidity sweep, if you have that, or inducement, and then you're good to go. Okay, so this is what we're going to be looking at for when we look at the market. And literally now we've looked at Bitcoin, we've looked at New Zealand dollar, we've looked at dollar CAD, and we can choose to look at multiple pairs, and you see the same thing over and over and over again. Here we have XRP, Ripple USD, and the same thing you're gonna see, structure, inducement, price sweeps, inducement taps into this, and price is dropping. Structure, the same thing, inducement, price sweeps, inducement taps into the supply zone, and it's dropping. It just happens like clockwork, over and over and over and over again. Okay, so hey, I want to believe this is really, really helpful to you. So what I'm going to leave you with is this. I want you to kind of go through price action in the market, try to see if you can identify all of these elements for different pairs. So for you, we've already looked at setting up a trading view. So I want to believe you have good idea of how to go about that. So you can just basically go through different pairs. Just pick any pair of your choosing, and just try to see, can you identify all of these elements in the market? If you can identify them, that would be awesome, and that would be great. So hey, this is what we're going to close the content in this. We're going to be going to chapter 2. We're going to be looking at trade and risk management, and after chapter 2 we're going to look at chapter 3. We're going to be looking at the exact stocking profit strategy models. Okay, so I look forward to seeing you in chapter 2, ladies and gentlemen. And please, when you also identify these things in the market, please submit your chart. Just put in the comment section and just post it there, and I'll be looking forward to seeing your growth. All right, guys, thank you, and see you on the next lesson. Bye bye and cheers.